Hey, welcome back. It's Jason Walter here. Home prices in the US continue to outpace expectations as tight inventory and low rates are leading to bidding wars. According to the latest S&P CoreLogic Case-Shiller home price index report that was just posted yesterday, it showed a 12% annual gain in home prices in February. That's up from 11.2% in January. That also marks the 9th straight month of increasing prices. And here's a mind-blowing stat for you. So the 12% annual home price gain is the highest recorded increase since February 2006, which is exactly 15 years ago. In this report, the top 3 cities in their 20-city survey that had the highest year-over-year home price gains were Phoenix, San Diego, and Seattle. Phoenix led the way with a 17.4% year-over-year price increase, followed by San Diego, which had a 17% increase, and Seattle, which experienced a 15.4% increase. And get this, Phoenix, Arizona has led all 20 cities in this report for the 21st consecutive month. The strength of the real estate market in the US continues to be very broad-based. So for example, CoreLogic reported that 18 of the 20 cities they monitor had an annual price increase of more than 10%. The only 2 cities that had price gains of less than 10% were Chicago with an 8.6% annual gain and Las Vegas with a 9.1% increase. And by the way, if you're getting any value out of this video so far, then please hit the like button. I greatly appreciate that. And if you're thinking about buying or selling a house outside the greater Sacramento area, then check out the link below or go to homeandmoney.com/Jason to get connected with a local real estate agent in your area. And the best part about that, it's 100% free. All right, so going back to this report from CoreLogic, what I'm most amazed by is the fact that home prices have increased greatly despite the fact that mortgage interest rates have risen sharply in February. Take a look at this chart of mortgage rates from mid-January to the end of February. The average 30-year fixed-rate mortgage decreased about 0.2% in the last half of January until it reached an all-time record low of 2.75% on January 27th. Then rates skyrocketed to 3.27% by the end of February. In other words, even though rates increased by about 0.5% in February, home prices surged. However, if we want a glimpse into the future about a housing market, let's have a look at interest rates over the last 30 days. This is because they have been decreasing for over 3 weeks. They went from 3.45% all the way down to about 3.1%. In my opinion, if rates were to remain around 3%, that should cause home prices to increase further, especially if there's not a significant increase of housing inventory. On top of this, if you missed my video from the other day, I discussed a brand new bill proposal, which is a first-time homebuyer credit of up to $15,000. If that gets approved, that could increase buyer demand further. In regards to interest rates, Federal Reserve Chairman Jerome Powell stated today that the Fed decided to keep the federal funds rate at or near 0% until labor market conditions have reached levels consistent with the community's assessments of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. What this means for a real estate market is that mortgage rates could remain at low levels given the fact that the federal funds rate is loosely tied to mortgage rates. And yet another reason why mortgage interest rates may remain at low levels is due to the fact that we had a dip in the yield of the 10-year US Treasury note over the last month. That yield is also tied loosely to mortgage interest rates. So when the yield decreases, that could cause mortgage interest rates to decrease as well. Okay, changing gears slightly, let's talk about mortgage application numbers in the US because those have been decreasing lately. If you recall, this is one of the metrics that I personally follow in order to gauge which direction our housing market is headed. For example, if mortgage application numbers for home purchases increases, this could mean that home buyer demand is increasing, which supports higher prices. In contrast, if there's less mortgage applications for home purchases, this could mean that there's a lower buyer demand, which could ultimately lead to a decrease of home prices. In any case, here's a brand new report from the Mortgage Bankers Association that was just posted today. Overall, mortgage applications in the US decreased 2.5% from 1 week earlier. However, in order to gauge our housing market today based on mortgage application numbers, we want to have a look at purchase applications. So this dip of 2.5% includes refis and purchases. So therefore, let me break this down for you. So the refinance index decreased 1% from the previous week and was 18% lower than the same week 1 year ago. The unadjusted purchase index decreased 4% compared with the previous week, but was up 34% than the same week 1 year ago. The report says that mortgage applications decreased last week, even as mortgage rates dropped for the third week in a row. The 30-year fixed rate was down 3 basis points to 3.17%, which is still 32 basis points higher than the low reported in December 2020. Even with a few weeks of lower rates, most borrowers have likely already refinanced, which is why activity has decreased in 7 of the last 8 weeks. The purchase market's recent slide comes despite a strengthening economy and labor market. Activity is still above year-ago levels, but here's a key point here. But accelerating home price growth and low inventory has led to a decline in purchase applications in 4 out of the last 5 weeks. And lastly, here's some crazy news for you. So remember how I've been reporting that it costs builders approximately $24,000 more to build a home due to skyrocketing labor costs, and those costs are being passed down to home buyers, right? Well, that has changed for the worse because the National Association of Home Builders reported today that because lumber prices have tripled over the last 12 months, it now costs $36,000 more to build a house. So take a look at this graph. This is the lumber's futures prices over the last 1 year. So 1 year ago, prices were around $320. Now they are over $1,400 to a near record high. Many of you have been asking, why is the price of lumber so insanely high? Because this is going to be causing new home prices to increase as well, right? If it costs $36,000 more to build a house, then that's going to be passed on to home buyers. The National Association of Home Builders had a really good explanation regarding this. So many mills reduced production last spring due to, of course, to the stay-at-home orders and social distancing measures at the onset of this pandemic. When it became clear in the ensuing months that housing weathered the storm much better than predicted and demand remained strong, lumber mills did not ramp up production accordingly. Moreover, producers did not anticipate the massive uptick in demand from do-it-yourselfers and big box retailers during this pandemic. Finally, the extreme lumber price volatility has been exacerbated by tariffs on Canadian lumber imports into the US market. If you enjoyed watching this video, then please hit the like button. I greatly appreciate that. And also consider subscribing if you haven't done so already. You also can follow me on Instagram. I'm Sacramento Realtor. Hope you have an awesome day and look forward to seeing you on the next video.